It finally happened. Cenovus has bought MEG Energy, announced just this morning. This has been absolutely massive news for the Canadian oil and gas industry, for Canadian oil and gas shareholders, for all of these different stocks that we're interested in. So today, let's cover exactly what this means for Cenovus shareholders, MEG shareholders, and of course, Strathcona shareholders. At the end, I'm going to talk about what I think as far as the investment options are going forwards for the rest of us on the outside looking in. On the screen right here, I have got the press release from Cenovus Energy. We're going to start with these guys before we switch over to MEG Energy's press release, because I think it's interesting what they're kind of pitching to their shareholders. This is their initial way, let's say, of showing their shareholders what the value those shareholders are going to get out of this deal is and convincing them to like this deal. Cenovus announces the deal. The actual details are right here. Under the terms of the agreement, Cenovus will acquire all of the issued and outstanding common shares of MEG for $27.25 per share, which will be paid 75% in cash and 25% in Cenovus common shares. When I first read that, I was like, oh, so every shareholder is getting 75% cash and 25% shares? Well, according to the deal, each MEG shareholder will have the option to elect to receive for each MEG common share either $27.25 in cash or 1.35 Cenovus common shares, subject to proration based on a maximum of 5.2 billion and 84.3 million shares. So basically, Cenovus has 5.2 billion on hand ready to do this deal. Not quite the amount they're offering at 7.9, but they also have these shares available. So this is an interesting mix of both, yes, a little debt, but also using some of the cash they had available and using a little bit of dilution. I don't know if this is going to be something shareholders love or hate. So far, the market likes it, which is generally a good barometer on what shareholders are going to think. But the ones I've talked to so far this morning are waiting sort of to see how the dust settles before they make a big statement of opinion. And then we get to the good parts. Transaction highlights. Again, this is the pitch deck for their shareholders. First, this reinforces Cenovus's position as the preeminent SAGD oil sands producer. Brings together two leading SAGD oil sands producers with a combined oil sands production of over 720,000 barrels per day, the lowest steam to oil ratio, and the largest land base in the best quality resource area in the basin. Basically, we're going to see these guys become a much larger player, which is probably a good thing. It's also probably going to have some synergies that we're going to see as we go down the list, and their resources are conveniently close together. They have an exceptional asset fit. So they consolidate adjacent, fully contiguous, and highly complementary assets at Christina Lake, where they were basically like next door neighbors. And they enable integrated development of the region and unlocking significantly accelerated access to previously stranded resources. That's interesting to me. I guess that meant that between the two of them, because of the artificial barriers they had put up, I was like, oh, I own this half, you own this half. There was some resource they couldn't get at, and now they can. Interesting. Then it's the interesting part. We saw this same kind of language when we saw Whitecap and Varen merge. But look at this, 400 million of annual synergies. Cenovus expects to realize approximately 150 million of near-term annual synergies, growing to over $400 million per year in 2028 and beyond. That's huge. That's obviously corporate synergies, commercial synergies, development and operating synergies. That's a lot. And it's a huge benefit right now, because right now we're staring down the barrel of lower oil prices. That's the story of the end of 25. And anytime you're in a low oil price environment, you want to be a low cost producer. It's something we talked about actually at the start of the year when we thought the low oil prices would come right away. Instead, we've seen that kind of delayed by weather events and geopolitical tensions, et cetera, et cetera. And now we look at the low oil prices that we expected this year coming on force at the end of the summer going into the fall. In that environment, being in a position where you are a lower cost producer is huge, and promising that to shareholders might convince a lot of those shareholders that this deal is good for them. We also see that this is immediately accretive. This is supposed to be immediately good for free funds flow, for free funds flow per share. Huge if you're a dividend investor who owns this stock, like so many are, and you're worried about that low oil price impacting your dividend. Finally, maintains a strong balance sheet and continued focus on shareholder returns. It's been structured to preserve their balance sheet and investment grade credit ratings with pro forma net debt of less than 1 times adjusted funds flow per strip pricing. Cenovus will remain a robust financial framework to continue to balance deleveraging with meaningful shareholder returns. So essentially, yes, they're taking on debt. Yes, it's $5 billion in debt. That's a significant portion of this deal. but it's still under 1 times AFFO, which is a good thing. And it puts them in a position where they can afford to get back out of debt. They're not going over leverage here at a time when their potential growth is muted and their profitability is muted thanks to that low oil price potential in the future. They talk about the financing plan. I don't know that any of us are all that interested, but if you are, it's about half a loan facility and half a bridge loan. The bridge loan is going to be replaced by a bond offering, a senior note offering, which is probably going to have quite a long-term expiration date. I would assume I would go for like a 10-year if I were them, because I think that's the kind of time frame where they're going to be like, oh yeah, we'll be in a much better position versus like a shorter time frame where there's a lot more uncertainty. And then there's just a couple timings things. So they expect to close this in the fourth quarter of this year. Obviously, that there's closing conditions, regulatory approvals, et cetera, and approval by MEG shareholders, which may not happen. We'll see, I guess. I mean, the MEG situation has continually confused people, so maybe it will do that again. But I think we can expect to see this close November, December, probably, of this year. And it'd be really interesting to see, because that's going to be pretty ideal timing to put some synergies together as, again, oil prices start to drop. So while Cenovus shareholders are still sort of left to think about, is this a benefit to the company? You know, I see the accretive nature. I understand that this is going to be a good synergistic partner to work with. We have similar assets, doesn't necessarily bring down the balance sheet, et cetera, et cetera. MEG shareholders are now in a different position. And this is where we jump over to their board of directors and we look at what they are saying. Because MEG shareholders were kind of split over the last couple months. Some of them already sold their shares to Strathcona Resources. And Strathcona is like, what? I've already got X number of shares, which I suppose they're going to either vote with to either approve or not approve this deal. Probably not, I'd assume, but we'll see. And a lot of MEG shareholders have already sold out and might be missing out on the opportunity. I mean, this is theoretically a premium to what they were offered already. So interesting point. But those who are still holding shares are probably in the camp where they didn't want the company to be sold. That's what we saw brought up by guys like Eric Nuttall, who's one of those guys that really championed the cause of MEG Energy. He said, I don't want to sell my shares here. I think this company can grow. I like the assets they own. I don't want to be diluted by owning a bigger name that has, yes, these high quality assets, but also others that I think are lower quality, et cetera, et cetera. Now, what MEG Energy does say, I think shows a little bit why they chose this deal. Really, the whole story is just that it's more money. I'm going to be honest with you. But there's a couple things that they offer to make shareholders saying like, okay, this is going to be beneficial for you. And in some part, it might be a little bit of a personal thing because they're going out of their way to show what Cenovus is offering that MEG shareholders should like. So they start their deal by showing off the share purchase price and saying sort of how that's going to go. It's a 33% premium to their unaffected 20-day volume weighted share price as of May. And if you remember, MEG shares have increased significantly over the last couple of months, basically, as people saw the Strathcona deal and jumped on that. So they've been talking about this for a while. Cenovus didn't want to pay a huge premium over the current share price. Instead, they're paying a premium over that May share price back when this was sort of a big news story. Cash and highly liquid share consideration provides them with near-term value certainty. So look, they're saying highly liquid share consideration, pointing out this is different than Strathcona Resources, where buying MEG was going to increase the liquidity of the stock. Instead, Cenovus is a very liquid, very traded stock. Upside participation in an industry-leading producer with significant scale and growth potential. Sure. Accelerates and de-risks realization of value from MEG's standalone plan. Sure. And unanimously approved by the board of directors. Unanimous approval. And of course, they talk about the same details of the deal that we just covered. They talk about how they came to agreeing to this. And then in bold, we get the interesting part, the benefits. It's the same idea, right? They're pitching this to their shareholders. So what are shareholders going to get out of this? Well, you see right there, premium, 33% premium to the deal before, the last trading day preceding the first public announcement of Strathcona's intention to acquire MEG. The transaction is valued at $7.9 billion, which is what, $0.9 billion more than Strathcona was going to offer, but still is a premium over that. Certainty of consideration. Consideration makes a high degree of value certainty, 75% in the form of cash, 25% in the form of highly liquid Cenovus shares. So there's more cash on the table in this deal, and there's a more liquid share base, which means that more shareholders can be certain to get the value they expect out of this, versus some shareholders, especially people who went out and were talking on the media, said that they were worried about owning Strathcona Resources shares because they're so overwhelmingly owned by the Watrous Energy Fund. Now, personally, I think Adam Watrous is a fantastic asset allocator, and in this industry, he's one of the guys that you want to listen to and you want to be invested alongside. But not everybody agrees. So I understand people not wanting to be trapped in a stock where somebody else can make big choices because you're not a majority shareholder. Upside participation, significant synergies. It provides MEG shareholders continued ownership in Cenovus, an industry-leading producer, significant scale and growth. And then it talks about the same synergies, 150 million in near term, 400 million per year in the next 3, basically, by 2028. Accelerates and de-risks their standalone value. Brings forward substantial value from their standalone plan, including the expansion project at Christina Lake, growing production capacity to 335,000 barrels per day, which will continue to advance. And this is I love this, superior to the unsolicited Strathcona offer, because that offer includes consideration per MEG share of $4 in cash and 0.62 of a Strathcona share. Share component of the unsolicited shareholder offer represents approximately 85% of the total consideration, versus Cenovus offered 75% cash. So I think that's a big part. And again, there's overhang risk of selling from Watrous Energy Fund and its partners, et cetera, et cetera. So MEG shareholders are going to vote on this in early October. Again, I expect this to close probably late November, December, right? They say Q4, but if they're only voting in October, I would expect this to only close by the end of the year. And I think it's a really interesting deal. I think it's really interesting for Cenovus and MEG shareholders. But of course, there's one group of shareholders we haven't talked about yet that this will definitely impact. On the screen right here, I've got a chart that shows the last year of Cenovus and MEG, those two companies we've talked about so far. And of course, SCR on the TSX, which is Strathcona Resources. Now, when Strathcona Resources first initially proposed to buy MEG Energy, there was a lot of debate. It was really a big thing that divided the investors in this industry, the media proponents of this industry, the boardrooms of this industry a lot. And we don't see that a lot here in Canada. We see a lot of these boardrooms friendly all the time. A lot of the investors have nothing mean to say about each other because everyone's more or less on the same side. It's a niche enough industry at this point. It has a small enough base of people who are sort of big names, media names, that everybody kind of knows everybody and they're all friendly. It's also helpful that basically everything is done out of the same town in Calgary, and it's kind of awkward if you're being mean to each other if you're the next office over. But this did divide the industry quite a bit, and it put a split between guys in the Strathcona camp and guys that either didn't want MEG to sell or wanted MEG to sell somewhere else. Now, Cenovus kind of sweeping in and purchasing this is definitely a little bit different. We saw this whispered maybe a month ago now, but we didn't really see any big opinions about that the same way we did when this initial deal was offered. But if you do look at what's happened since May, and remember that May 15th date, which we see just right here, I'll cursor over to it. So if we go over to May, this is May 15th, we saw MEG was down 20% for the year, Cenovus was down 23% for the year, and Strathcona was up 3%. And then as we scroll to now, Strathcona has absolutely dominated the other two, up 32% this year, which is, again, absolute domination. MEG is sitting at up 3.5%, which has moved almost 25% from that down 20% we saw earlier. And Cenovus is up to down 9.9%. Now, if we zoom right into the last month, you'll see that while Strathcona has kind of been continuing its climb and MEG has been more or less stable, let's say, for last month, up 3%, Cenovus has jumped over the last day. It's actually been kind of on this interesting upwards trajectory, which makes me think that people knew this was going to happen. If you look at the last 3 days, we see it go from up about 6%, up to 7%, up to 9%, and today up 13%. So there's like a significant rounded bottom to that upward trajectory. It's not like a straight jump. Again, it makes me think that shareholders were getting their positions ready, taking advantage of the bump. Strathcona shareholders are in a pretty good position right now. So not only have you, if you're a Strathcona shareholder, earned 30% this year in an industry that is across the board down with, natural gas prices artificially lower thanks to all sorts of unnatural weather events and all sorts of sort of confusing decisions from boardrooms, with oil prices being artificially dropped by OPEC, the industry as a whole has definitely had a struggle. Strathcona shareholders are like the only ones out there that are kind of just sitting there like, oh, wow, this is great for us. And importantly, we saw in July, actually at the Calgary Stampede, we saw some news come out for Strathcona shareholders that should make you very happy that even though you lost this deal, that you're going to get a $10 special dividend. I just wanted to let that sink in. $10. Now, maybe it won't happen. Maybe that was just something that he said, Adam Watrous, but like that's a huge special dividend. It's a lot of money. It's a lot going out to shareholders. I mean, I wouldn't be unhappy to take that. I wouldn't be unhappy to take even, a few percent special dividend, like, and then the rest is reinvested. I would be happy across the board. I'm interested to see the direction Strathcona goes. They've also sort of made an interesting play going all oil at a time when natural gas seems like it is just like in prime position. A lot of companies are really focused on the natural gas side and are really counting on that to get them through this low oil price period. We'll see where Strathcona Resources goes. And again, if you're a shareholder, let me know how you feel. If you're a shareholder in any of these companies, because everybody's more or less done better since this drama started than they were doing before. If you're a MEG shareholder, if you're a somebody who didn't want the company to sell, maybe you're not happy with the results, but you're getting into Cenovus. Maybe you don't love that now you're in a company that not only has a great upstream basin, but now you got the same downstream production problems that we've talked about on this channel for months at this point. So maybe you're going to be a little bit peeved that happened to you, but also maybe you're happy you're in a big liquid name and you can take your cash and walk away. Really interested to hear some shareholder thoughts in the comments down below. Let me know. What do you think about this? Are you a fan? Are you against this deal? I would love to hear your thoughts. And as always, if you like what we do here on the channel, you like this video, please do like it. If you like what we talk about, you like covering these kinds of companies, do subscribe, and I'll see you in the next one.